All right, stocks continue to fall today with a little bit of an extreme range today. So what does that mean in terms of, are we going to continue to build upon this selling to the downside? Are we going to hammer around this low point? Are we going to immediately bounce back up to the upside? What have we seen before? And how does that shape what we expect to see going forward? So I'm going to break all that down in today's video. We're going to look at a stock that previously had been on my bullish watch list, where in fact we even made a trade on it before in one of our premium classes, Market Scholars. But now it's flipped to the downside and is giving us a good opportunity, as we saw on Friday, to make a quick trade to the downside. So let's go ahead and get started. Today is Monday, May the 13th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. And of course, we pull back again today, pull below the lows of last week, down to that 23% Fibonacci retracement level. It's been sitting there forever. As we kept dragging as we moved to new highs, we kept pulling this up. And we mentioned that at some point in time, neither one of these pullbacks even got close to 23%. In fact, if you look at here, let's activate that and bring this down here. And you can see that one came the closest to hitting the 23% mark. This one didn't quite get there, only got about halfway. And finally, here's our first move where we get, there we go. The first move where we get a pullback to the 23% Fibonacci retracement level. So level we've been talking about. In fact, even on Saturday, in Saturday's Q&A session I had on MarketScholars.com, I even mentioned the idea that this intermediate pullback's not done. All right, we weren't below 50 yet. We still could trade within the range, the lower end of this range down towards it, and took all of one day for that to happen. Now, granted, there's some support in this area around 2,800. Multiple touches in this area. We'll see some more here in a minute on some other charts. And of course, the next layer of support, which again is a very typical layer of pullback, right? That's a typical retracement, is to come down 38% of a move or bounce up 38% of a downward move. And so, we haven't even done that yet. And you can kind of get an idea that if we were to continue this little strong bearish drop that we've had right now, then you can kind of get an idea. By after May expiration, by the end of the month, within the next couple of weeks, we could be heading towards 27-21. I've said for a while that a pullback towards this 23, because we kept pulling this line up higher and higher and higher here. I've said before that that if we here, get that line up in the same line. There we go. That if we did pull back towards this 2,800, which is a 5% pullback, it would be uncomfortable, and it has been. It's pretty much, here. One of the things I retweeted over the last little bit was this tweet from where is it? This tweet from Charlie Bilello here, where he says this is the 24th time since that March 2009 low point that we've had a 5% correction or more. And like he said, they all seem like the end of the world at the time. Now, granted, this is only 5%, and this is from high to low, right? If you look at on a closing basis, just from close to close, we're only down 4.5%. We still haven't dropped below this tag here, the last pullback that we've had of at least 1%, right? Here's all the 1%, all the tags for all the 1% pullbacks and subsequent bounces. So we had a nice little rally here. Let me get rid of that high sticker so we can see. We had a 5.25% rally off of that low point, and now we've almost pulled back just about all of it. Now get below it. Now we're down. Now that's something similar to what we had over here. Once we got below the last tag, that was something, right? Then we had a significant drawdown. You can see previously heading into that. Here's the highest closing level right here. To this point, we were down 1 3/4%. So we would have had a red tag there that said 1 3/4. That would have almost pulled back the entire drop, but then of course we fell through that in the last last couple. So we're not close to these other. In fact, that's where the 38% Fibonacci retracement level is. So if we break below this one, that's our next layer of support. And like I said, the Fibonacci retracement lines tell us that could happen as early as the end of this month. Otherwise, even if we do bounce off of this support, even the here, pull back up this 20 bars out. Even if we bounce up off support, I still do think that by, if we bounce up towards this 2850 area, that will probably still end up trading here for the next few weeks by the end of the month before we hit this layer of support where the Fibonacci fan is and bounce off of it and then continue any bullish trend higher. Otherwise, if we continue to fall, then the 38% Fibonacci retracement comes into play at 2720, and that's going to be nearly a 10% drop. And remember, if you go back on this and change this zigzag here, any 10% drops that we've gotten have pretty much all led to death crosses on the 50-day and the 200-day moving averages. You can see here we had one. Obviously, we had the 20% drawdown there. We had a 10% drawdown in early 2018, 12% in 15, 13% in 16. Those were all both death crosses there. And before that, 2011, a 19% drawdown. So you can see we don't get very many 10% pullbacks. In 2010, when QE1 came off the tables, and we had that head and shoulders pattern and rallied with QE2. But you get the idea. You get these 10% plus pullbacks are they're pretty significant, and that would be actually getting down to the 38% Fibonacci retracement wouldn't quite be a 10% pullback, but it'd be, if it will let me, there we go. It would be down to about, looks like a 7.5% drawdown if we were to close there. So it's getting closer, obviously getting down to these levels, the 50% retracement level. That would be your 10% pullback. That gets us down to 2650, kind of where that would be another significant. I mean, there's multiple layers of significant support as we come down. This just being one of them. If you look at the Bollinger Bands here for SPY, that 280 level is where we're at right now. That's where a big major volume node is. Here's where the 38% Fibonacci retracement level is. Another big major volume node. And finally, this area right here is where the 50% Fibonacci retracement node is, and that's where the bottom end of the volume channel, the 70% volume channel, is for the past year. That's where that level is. That's another. So that's where we have not only we have technical Fibonacci support in those areas, we have multiple touches in a lot of these areas too, as well as some volume support. So it's not going to be easy to free fall back down to December lows. There's going to be layers where buyers are going to be willing to come in here, no matter how doom and gloom the news appears, according to that tweet I shared with you before. Of course, as we fall, everything looks the same. So right now, and one thing to keep in mind too, in terms of are we going to bounce right back up? We do have dark pink shading, and we'll have a red line tomorrow. So we are below the moving average. The moving average has gone from 2901.64 to 2900. So it's falling now. The moving average is falling. So you have the bearish combination, red line, dark pink shading. So I don't think that this will be a quick little foray below 50 and then bounce right back up and start heading lower. We'll be down here for a while. Here we were down for about a week or so. Like I said, according to the Fibonacci fans, we'll probably be around here for through the end of the month at least, before we head into June. Let's take a look really quick at the Dow, and you can see it's a lot further below, and it also has that bearish combination. But you notice we're not getting extreme lows in the momentum line on any of these. This was the closest. The NASDAQ was the closest with the weakness in tech. But you can see how far below the moving average we are there. And then the Russell kind of breaking back to its former 23% Fibonacci retracement level. Now we're kind of in this area and close to breaking back below that low point. You can see 38% Fibonacci retracement is going to be a little bit below 1500, and you can see there's multiple touches from that end, but also bearish combination of dark pink shading and a red line. All right, before we look at some other charts, I invite you, number one, subscribe to our YouTube channel. Use that mouse over our logo right here in the bottom right corner of our screen. Hit that red subscribe button that pops out. That will notify you when these videos are posted. Number 2, click the thumbs up icon down below the video. That tells us you want us to do the video again tomorrow. Quick, easy way to give us feedback. You can do that right now while you're watching. Number 3, comment on anything that stood out to you from our video today. Join our Daily Market Outlook email list. There's a link popping out up there in the top right corner of your screen. Click that link to subscribe to our list. Follow me on Twitter for more content in between videos from day to day, and join our community that we created, our Market Scholars community that we created on Facebook. Again, if you're watching our video on our blog, remember we're looking for 3 clicks here. Number 1, click on this heart. That opens up a new page here where you can like tonight's Market Outlook tweet there. Also click on this image, takes you to our Facebook page where you can like today's Market Outlook Facebook post. Finally, a 3rd click right here on this page. That's part of our community system here on the website. Also remember you can share the Market Outlook across Twitter, LinkedIn, Facebook, on email with this, and of course a very easy way here also to subscribe to our daily email that we send out with this Market Outlook video and summary and timestamp summary posted on it as well. Alright, back to the charts. As you can see on the long-term charts, of course, another weekly candle, but it's only one day, so we'll see how this plays out. And a lot of times when you break below a 50-day moving average like this, and you know the 50-day moving average is falling, if you don't bounce right back up above it, the next week you typically head towards that 50-day moving average. You can see lots of examples where you get below it and bounce right above it, even like right here. But if we don't hold it, if we stay below it, then we'll most likely fill in the gap between the 50 and the 200 and then bounce off the 200 and make our way higher. That's the typical pattern that we never saw here because we never tested the 200-day moving average since breaking through, which is rare. So not surprising that we're finally getting that, where we're going to come down here and 2780, just to kind of put in some perspective of where that's at. That is right in this area, so just a little bit below the 23% Fibonacci retracement and above the 38%. So that's where your 200-day moving average is. So don't be surprised if we don't trade at the least, between there and here and 2800 and this blue line up here, which is the Fibonacci retracement of this last near-term rally that we finally broke through. That's kind of the area I think that we'll be going up and down in, similar to how we did over here as we head towards the end of the month. And again, otherwise, 2,700 down into this 27, down to this 162% level of that pullback. That's where if we were to continue the free fall, so to speak, and even though that's still just Fibonacci retracement, but if we were going to continue this kind of sharp selling, that's where your layer of support is going to be. Personally, I expect the former, especially since so many people expect the latter, but of course anything can happen. If you take a look at the Heikin Yashis, as we mentioned last week, we got the transition candle, so not surprising that this week we're getting a bearish candle, and we mentioned that we'll probably get a couple of these as we head towards this 200-day moving average here, just like we did over here. And so here's number 1. It's going to be very rare that we'll get up to a new high here. So we're probably going to end up with some bearish candle. And next week we'll probably end up with another bearish candle before we get another transition that will lead us back up to the upside. And obviously we'll be able to see that coming if and when it does. Now let's take a look at the 3 green arrow chart. Of course, we have 3 red arrows. Remember, now we have a falling moving average too. So pink shading here with the 3 red arrows and a red line is a bearish pattern. That's why I don't think we're going to bounce up immediately now. Originally, if we would have bounced up right here, we'd have been fine, similar to here. But now that we've pulled back, we're probably not going to bounce up immediately and get 3 green arrows anytime soon. If you take a look at the 2-line versions of these, you can kind of get an idea. The stochastics, it's close to falling in the reversal zone. It would have to turn up and get back out of the reversal zone to get the green arrow. You see the MACD is below 0 itself. So we're probably going to be in the mix between this kind of a pullback here, probably not to the same exact extent because that's what produced a death cross here, and this pullback, which was more lighter. The MACD didn't fall as much. Obviously the MACD is already down as much or more. And you remember too, when you look at the long-term chart here, excuse me, not the long-term chart, but this daily chart, you can see this is the PPO, the percent price oscillator. So it looks at MACD on a relative basis relative to that red line here, the slower line in the MACD, which measures the gap between the green and the red lines up here. It also is just a smidgen below that line. So, we are a little bit more bearish, obviously, than we were on this intermediate pullback. Probably not going to get as bearish as this one, depending upon, obviously, how the market continues to react to these trade jitters. Probably going to be somewhere in the middle before, as we hammer out and build a base around these Fibonacci retracement levels. All right, so we ended up with a new lower low today, and a new lower high for that matter. You can see the gap here. That's going to play in some significance here in just a second. It's about from 288, just over 288 to 283.49 as the high. So you had about another 4.5 points of range overnight that contributed to the total range. You'll see in a second, but we notice how we traded below, fell below yesterday or Friday's low, which was also last week's low, broke through it, tested for resistance, came down to a new low today, came back up, tested it again as a resistance before falling down and closing below and closing closer to the low of the day and below Friday's low point. So bearish close, to say the least. And you can see we're still only about a 15 point move. 29 is where you start to really stretch that rubber band. So we're only about halfway there if we're looking for extreme lows, which I don't think necessarily we're going to get here. If you take a look now and take a look at the range for it today, you can see it's 3.5 points. But remember, you have to add on 4.5 points of overnight trading. So really, we had about over an 8-point range, and the average is only over 3 points. So it's a pretty extreme range and strong volume down there, 127 million. So let's put that in context. 127 million's up here. So it's relatively bearish, obviously bringing the line up. But the 8-point range is way extreme. And so that's bringing this line up here. And of course, getting the 2% mark is the mark where it's like, oh no, right? That's too much. That's too much selling. We would have been fine on this pullback had we held here. And that's kind of where we're headed, at least as of right now. But to get an extreme ranges like that, they're very hard to sustain. Big extreme ranges. In fact, another thing I tweeted out was this idea of how many 2% and 3%, 2% moves, 1% moves that we've had. You notice so far this year we've only had 14 1% down days. We're almost halfway through the year. We've only had 14 1% up or down days. And the average for any given year is 60. We only had 8 in 2017, so that kind of shows you how insanely low volatility 2017 was. No 2% days, no 3 or 4, and we typically get 3 4% moves in a year, and we've only had 2 last year. In fact, we've only had 2 for the last so many years. We usually have 7 a year of 3% down days, and most of them coming in the big bearish years, of course. We've only had 1 this year, and we had 6 last year, so it kind of shows how volatile last year was compared to that. But then you look at this, and we were pretty much average. Last year was a pretty average year in terms of volatility. Not too bullish, which was the previous couple of years. Not too bearish either, because those are recession. You can see the recession years, 72 2% days versus 20 we had last year. That puts last year in a little bit of context here. Even the bounce back year in 2009 was a lot more volatile than last year was, and so far what this year has been. And if you notice here, when you go to this chart and you do look at that volatility chart in 4K, when you do get these big 2% moves to the downside, if you look at when we get the 2% moves to the upside, all the green ones, they typically come after the 2% moves to the downside. So we almost got one there. Here, eventually we did right there. Here was a close to 2% move to the downside. There's a bounce. Here's some 2% moves to the downside, and there's a 4%. There's our 4% move to the upside last year, and then another 2% move to the downside, followed by a 2% move to the upside. So as of right now, you can see all the 1% moves. We've had 1, 2, 3, 4 to the downside. Most of the 1% moves have been to the upside this year. In fact, here you can look at it better this way. If you look at year to date. So just looking at this year alone, and this is on SPY, mind you. And if I were to take a look at SPX instead, so you can see we had 1, 2, 3, 4, 5, 6, 7, 8, 9, 9, and close to 10, but 9 days where we've had 1% moves to the upside, and we've had 1, 2, 3, now 4 and 5 1% moves to the downside. It could look, that's 14. That kind of gives you an idea of where we're at and just how volatile this is. And now that we've had a 2% and 3% move here, you can kind of see here the last 10 times we've had that, all within the last year, right? So between, as I just showed you some of them, you can see the returns the next day have been, for the most part, positive, and for the next week have been about on average 2% higher, with a couple. You can see in December of 2000, during that Christmas pullback, we had a couple 1 week negative returns there. So you can, you get the idea that when you have these extreme moves like we've had, they tend to be bought. Now again, I don't think we're going to rise up to 3,000 anytime soon, and I do think we're going to spend more time in this area. But I think it's going to be some more ups and downs in this area. If I go back to the 1 year chart, similar to here where we had ups and downs while we're in this area, potentially even trading a little bit lower towards that 200-day moving average. Finally, let's take a look at the volatility index, which closed above 20 today. This is the first time it closed above 20. We had over here on 5/8, we closed at 20.06. But just to kind of get an idea, this was, obviously we're at 2017. That's on the hourly chart. If you look at the daily chart, which includes the the extended hours trading, then on the 8th we only closed at 1940. So that kind of gives you an idea that extended hours trading on the intraday, I don't have the extended hours trading showing there. So so this is the first day we've closed above 20 on the VIX. We're still above the 200-day moving average. And again, a reminder, that's not necessarily the most bearish thing. Usually we're 1 week later, it tends to be a pretty positive thing. 1 month later, tends to be pretty positive. And of course, the 1 year returns. So it's doom and gloom, right? Every time we get a pullback like this, it is doom and gloom. But it's not necessarily, the world isn't necessarily going to end. If you look at the volume today, so on Thursday at the open, we went all the way up above 22, got up to 23 right at the beginning of the day, and we kind of went past 105% mark. Today, obviously, we're to lower lows than where we at on the S&P, but we still traded around 20. We didn't go up to 25. And we still are around this 105% level. We didn't go up to 115%, which is that surge level, which means we're going to be bearish for a while. Even if we're not going to drop down significantly, like the 20% returns, we're probably going to be at a 10% return, trading below the 200-day moving average for a spell, like early 2016, late 2015. All right, so now you get a chance to vote on that. Do you agree or disagree with that market outlook? There's a link popping out top right corner of your screen. Click that link. It opens up a poll. Then hit either agree or disagree. If you click disagree, because either you're more bullish than that or you're far more bearish than the picture I'm painting going through our routine here, then let me know what you're seeing. Like share with charts or anything else that you're seeing here with the Market Scholars community that would suggest like I said, either a more bullish or a more bearish outlook than what we just came up with. All right, so as you can see on the chart, it was obviously a risk-off day today. Gold and long-term bonds were the biggest movers. The dollar ended up being relatively flat. Remember, it's had that fake-out move where a couple weeks ago it broke out above $98, and in the last couple of weeks have fallen back down below 97.5, which is where the kind of big breakout's been. So it has been unable to be too bullish, and then of course you can see crude oil started off today strong and then fell by the end of the day. And interestingly enough, agricultural commodities, which has been really the biggest loser. If you go back over like the last 6 months, you can see this has been the telltale sign of how the market's been pricing in these tariff expectations, right? The trade deal expectations. While the market itself has been more bullish, you can see DBA has not been. That divergence is a reflection of what the markets, at least in the agricultural markets, were expecting from these trade discussions. And then finally, you see stocks have pulled down along with it. But As you saw there for a second, that agricultural commodities didn't fall. While they've been the biggest losers, they weren't the biggest loser today. In fact, they kind of held up pretty well and outpaced corporate bonds at the very least, and outpaced crude oil by the end of the day. You can see, not surprising, your biggest higher beta names, emerging markets, IWM, fell more than developed markets and large cap stocks. Let's take a look at how the foreign markets here performed, because remember, this is supposedly a trade war, and you can see the biggest losers here. In fact, let's go to the combined. The biggest losers: Canada, Russia, Mexico. These are all smaller losers. Thailand. On the other end of the spectrum, you can see Brazil down to new 3-month lows. Taiwan and Korea caught up with these with the trade war issues going on with China. You can see China really dropping significantly, down over 3%. All emerging markets down 3% here, and along with small cap stocks in the U.S. There's ACWI kind of matching what the S&P is doing, and you have your developed markets that are down, just not down as much. You can see the S&P is down below its moving average, just not very much. UK more, so Germany kind of matching what the US is doing, same with France. But the emerging markets are the ones, and Japan have been the biggest losers, and Italy, which is like an emerging market there in Europe. They've been the biggest losers, and they're getting to the point where they're falling below some extreme lows. If you take a look at like China, for an example, and you look at its linear regression lines, as significant as it's been, here let's pull up FXI. As significant as it's been, you can see falling below, but if that's on a 1-year chart, because a 1-year chart takes into account a longer time frame. So if we're just looking at this kind of most current move, then we have to go to a smaller time frame. And if you look at the 6-month chart, we're falling below the 2 standard deviation channels. So a reflection of just how bearish and how fast this bearish move has been, and look at the extreme volumes down there at the bottom. Again, would suggest at least a temporary bounce. I don't think we're going to now take off to new highs, but I do think that we are going to have at least a temporary bounce here from this extreme selling, and then continue to build around, trade around these low areas that we've just formed over the last week, and especially today. Interestingly enough, if you look at the rate cut odds, they are now over 70%, so up to 73% for December. Let me just refresh that to make sure that it's up to date. 74% now. Remember, once you get above 80 and it holds above 80, that's kind of where the market bakes that into the cake. And once it gets baked in the cake, that's when you start to see yields across the board fall, not just like this, because that's what happened here in 06, immediately after the Fed stopped raising rates. But I'm talking about like right here where the Fed was likely to cut rates, and they did right where my cursor is in September. So you see how that from peaking in June to September in 07, that's the amount of time that the market was pricing in the rate cut. Right now we're in May and we have December. If December odds get above 80 and stay there, you'll start to see these fall down. Now remember, the market peaked in October. So that doesn't mean that the stocks will fall, and we could still be bullish in stocks going forward from there. But once you start cutting rates, unless we're in a 1995 scenario again, once you start cutting rates, then you're going to be in a rate cut cycle now. So that's, in fact, you see, we have 70%, 74% odds of cutting rates. We have about, out of that 74%, 30 some odd percent, 1 out of 3 chance that we'll cut it twice by the end of the year. So, and then you look into January and you can see now we have 78% odds of cutting by next January's meeting, and what would that be? About 40% odds that we'll get 2. So that's the concern, right? Because usually the market will peak somewhere around that time frame where you start the rate cut cycle. Of course, from a news standpoint, in the trade data is the one. There wasn't really anything on the calendar today. the trade data was the biggest news. You do have import and export prices, and then we start to get the basket of data coming out, especially on Wednesday. We actually have quite a big basket there, including retail sales. But remember, the economic indicators as a whole have been falling. If you look at like the Empire State Manufacturing Survey, the trend since last August, and this has been the case for a lot of these indicators, has been to the downside. And that's reflected in this economic surprise index, which has also been falling pretty much since that August time frame down to these negatives. But you notice they're not falling to the same extent anymore. They are kind of globally, but not anymore from a U.S. standpoint. We're actually back up above negative 40. So we'll see, if we continue to move our way back higher here, that will also be another, you can see for 2017, for the most of that year as it rose back up, remember how non-volatile that year was and how bullish the year was? Well, that's, if that's the reality, if we get that kind of move in these economic indicators and start beating estimates again, that will halt the downward pressure in terms of risk appetite. All right, so I mentioned before, one of the signs that the market is topping is a lack of correlations among the sectors. Different sectors start to do different things. Once we get really bearish, everything starts falling. Well, if you notice, utilities actually rose today with the drop in yields, and real estate actually ended up flat. Now everything else, staples held up pretty well, staying above its moving average. Technology is looking like the broad market as a whole. It's been a main driver. Communication services, same thing. The consumer discretionary, all looking kind of like the broad market. Healthcare bouncing down on this bearish trend. Materials and energy, despite the weakness in the dollar here lately, they've been down. They've been the most bearish here. So you can see now everything's starting to look a little bit more alike, while still some areas are more bearish than others. Today, interestingly enough, financials joined the 3% crowd to the downside if you include discretionary. Industrials as well, also kind of matching what those other sectors are looking like. And then there's your materials and energy, which have been the most bearish, outperforming. Still down, obviously, but outperforming the broad market, and your safe havens doing the best, which is not surprising. All right, well, as you probably noticed with Friday's Market Outlook trade example on Gap, when the markets are bearish like this, you can hit your 50% targets here really quickly. And if you can get them really quickly, like within that first week, take it, move on. Another stock that looks like it's setting up for potential move to the downside in that discretionary area is Netflix. This is a stock that actually we had a bullish trade on in our options trading class, as one of them. That has hit their stops during this pullback, and now is actually looking like a good move to the downside with a dark pink shading. The moving average is now falling, so it's going to turn red tomorrow, so that's a bearish combination. Of course, we also have, if you go to the 3 green arrow chart, look at Netflix there, you have 3 red arrows moving to the downside. You'll have that red line too. If you look at the Bollinger Bands for Netflix, we're not breaking below the lower band, but you are pushing it down, and you are breaking below significant volume support. See, the last couple of days kind of had some issues trading in that volume support area. Today, breaking below all of that, and you can see very little volume as you move towards this pullback to the downside. If I were to look at the same Fibonacci levels here, one second, let me just snap those lines. Alright, and then activate that again. We'll snap that to the low point. There we go, and snap this one up here up to its high. So yeah, you can see that we've got some room to run down towards Fibonacci support, down towards this 50% Fibonacci retracement line, which also lines up with the volume support line. Not a whole lot of volume here. We're clearing the major level of volume over the past year. And then the DMI also showing a bearish pattern here, getting back up above 25 on the negative line and dropping below 20 now on the positive line. And the black line ADX suggests we could get a trend going. And again, we don't need a big move to the downside. We just need to not make a significant jump to the upside. And you can see like we talked about in the S&P, if you don't bounce right back up above that 50, you can end up filling in that gap. All right, if you take a look at the options for Netflix, you can see if I were to go look at the bearish options, and we'll look to try to sell right around this 30 to 40 area. We'll see what we can get to 365, 370. By the time we get filled in, it's relatively wide spreads, but it's an expensive stock. We need at least $1.16, and we're getting more than that. So when we analyze that, throw that onto the break even and change this up here to 622. You can see you got pretty decent odds, and when you put that slice onto the chart itself, let's go back to the Bollinger Bands, pull up Netflix, and then throw that slice onto the chart. There's where our break even is. So we'd have to get right back up above that big volume node for us to even consider taking a loss, which again the loss would be $141 is what we'd be willing to take on this trade, because that's what we're trying to make, right? If I do lose that, it'll be easy to recover with a new trade to try to recover that loss with my missing. Remember, if we get half of that, if we continue lower relatively quickly in the next few days, and we get half of that down to $70, then we'll take it, right? If you can get 50% of your gain quickly, which you see, you can get it quickly. The rest of it takes forever. So if you can get it quickly, then we'll take it, and we'll move on and see if we can get the other half on another trade, and the front half of another trade, rather than waiting for it on the back half of this trade. All right, well, that does us for today. Now I want to hear from you. Use that link popping out in the top right corner of your screen. It takes you to our Market Outlook forums on marketscholars.com. Remember, you have to subscribe to participate there, but you can do it for free on our site. And post any new thread. Open up any new thread with any questions or comments you have about what we discussed in today's video, or anything we didn't discuss in today's video. And reply to anybody else's thread too. Let's keep the conversation going here. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on the video. Follow me on Twitter for more content in between videos from day to day. And join our Market Outlook community that we've created on Facebook, as well as our community here on marketscholars.com. Again, thank you very much for watching. Have a great rest of your evening, and we'll see you all tomorrow.